Hello and welcome back to another episode of the Investor Financing Podcast. And on today's show, we're going to talk about updates in DSCR lending. DSCR lending is basically a loan program for investors that basically uses the cash flow or the projected cash flow from the property. And as long as that covers the debt, the new debt payment by at least basically 120%, then you will qualify potentially for this type of program. So why these type of programs are so in demand is because you don't need tax returns. It's based on credit score, LTV, and cash flow of the property. It's that simple. Now, we're going to kind of dive deeper into this because there's what we call projection based DSCR loans. And that's using income from kind of like an AirDNA. And AirDNA does kind of an algorithm, and it pulls the data of what this particular property may produce as far as annual gross revenue, occupancy levels, average daily rate or ADR. And there's 3 lenders right now that really are able to use projection based. The rest of the DSCR lenders use long-term rental income. So when we're assessing these deals, I always ask, if it's a short-term rental, what's your projection for the next 12 months, your annual gross revenue? But also, if this were to be a long-term rental, what's that going to look like? What would be the monthly revenue, right? We need to know what the taxes and insurance, and if there's an HOA, we need to know that to calculate the DSCR. So now, with the economy shifting, the STR, the short-term rental programs for true projection-based loans have really cut back on their aggressiveness. Prior to about 2 months ago, they were lending up to 80% of the purchase price. Some are even lending 85% of the purchase price. Well, now most of them are doing 70% if it's a true projection-based DSCR loan. Hi, if you'd like to book a call with me and discuss SBA financing, whether it's a 7A or 504, where you just don't know where to start. Maybe it's a startup business, you're buying an existing business, you're buying a franchise, you're building a new office building, you want to expand your existing business. We have multiple solutions. I can walk you through the 7A and the 504 and the SBA loan process. And if you have any other questions on any other types of financing, I'm happy to book a call with you. The link's below. Look forward to seeing you soon. Now, if you can qualify, or if the property qualifies from a long-term rental standpoint on a DSCR, that's a different story. It opens up to all the different lenders and you get much better pricing. Most of the long-term DSCR programs have better pricing than the projection-based. So that's really the question when we're kind of diving deep into this. Now, what can you do if you're expecting to get 80% and you're having trouble coming up with the additional 10%? For the down payment or the equity injection? Well, you can go into what I like to do sometimes is go into a bridge loan. There's lenders out there that will do 12 or 24 month bridge loans. And what that basically is, it gives you a little bit higher loan to value. And the reason I like them in a market like now is because during inflationary times, rates are usually going up, right? And then when they're trying to get the economy going again, they're going to drop rates. And hopefully within the next 2 years, rates will come down a little bit, and it gives you time. So the point is that if you're able to get 12 months of income from Verbo or Airbnb, and we can document that, when you go to refinance, you're either going to put them on your tax return and do a conventional type of refinance, or you're able to use that income for a long-term DSCR loan with some of the lenders. So it gives you a lot of options. It gets you in now, and then you have options when you want to refinance in the next 12 to 24 months. So that's just an idea of things that are out there, but it's getting a little bit tighter. The cash out refinances on short-term rentals is more challenging as well. They're constricting. A lot of lenders were at 75 or 70% cash out. Now you're seeing 65% cash out. So we're seeing these restrictions tightening up the lending market right now. And I think we're going to continue to see this, especially in the short-term rental space. So anyway, if you have any questions, feel free to reach out. We can dive deep. I have other videos on DSCR loans if you'd like to watch those. But think about a bridge loan that might be a better fit. Then you're able to use the income when you file your tax returns, because you're going to put the income on your tax returns. And then potentially, if you qualify from a debt to income standpoint, you can go conventionally. Although most of my investors don't ever really want to go conventional. They like these DSCR loans because the loans are in the name of the business. The borrower signs as a guarantor, but typically most, not all, but most of these, if you're doing true business purpose loans, don't reflect on your personal credit report. So anyways, hope this helps. I'll see you on the next episode.